So for instance, if talks fail or if diplomacy with Iran hits a roadblock and the US starts to really up the pressure, we start to see really meaningful signs that there could be a military escalation between the United States, Israel, and Iran, that's going to put upward pressure on prices. That's going to increase the risk premium. On the other hand, if we were to see de-escalation, if suddenly the Iranians and let's say Trump's envoy, Steve Witkoff, have a meeting, even an indirect one in Oman, the UAE, somewhere else in the Gulf, I reckon prices fall and the risk premium gets cut a little bit simply based on the view that tensions are falling. Similarly, Russia-Ukraine. If there's advance on ceasefire talks, if there's increasing noise out of the US side that maybe sanctions are going to get dropped if Russia plays ball, that would yield a reduction in the risk premium because it would suggest things like attacks on energy infrastructure are going to become less likely, an increase in Russian exports or Russian oil moving back into the mainstream market becomes a little bit more likely. But overall, the risk of disruption starts to fall. But as far as how much risk premium is baked in right now, I think something I've been saying for the last couple of years is the market's gotten pretty good at managing risk, right? There's been a lot of noise. There's been a lot of disruption, a lot of headlines out of the Middle East and Russia, Ukraine over the last couple of years. But in many cases, it hasn't resulted in a really significant physical disruption. Russian flows have continued. Flows out of the Gulf have continued. So I think the market has gotten fairly good at managing volatility, applying a premium, but not a significant one, so long as the physical flow remains largely undisrupted. That's why something like Iran sanctions really matters, right? You have to see it reflected in the physical flows to really move the price one way or the other.
Okay, fascinating.